Most dividend ETF investors are leaving thousands on the table every single year, and they don't even know it. I'm talking about predictable, avoidable mistakes that silently erode your wealth while you sleep. Some of these errors cost investors 15 to 20% in potential returns. And the worst part? They're completely fixable once you know what to look for. I've spent the last decade analyzing portfolios, and I've identified 5 critical mistakes that separate successful dividend investors from the ones who wonder why their returns lag the market. We're going to break down each one, show you the exact damage it causes, and give you the fix. Let's dive in. Mistake #1. Chasing yield like it's free money. Here's what I see all the time. An investor finds an ETF yielding 8, 9, sometimes even 10%. Their eyes light up. They think they've found the holy grail. They dump money in immediately. Then reality hits. Those high-yielding ETFs typically fall into one of 2 categories. Either the yield is artificially inflated through leverage and risky strategies, or the fund is slowly destroying its principal to pay out those dividends. You're not getting rich, you're getting a smaller pie with a bigger slice. Let me show you the math. Say you invest $50,000 in a high-yield ETF returning 10% through aggressive strategies. Your neighbor invests the same $50,000 in a balanced dividend ETF yielding 4%. Fast forward 5 years with a 7% average annual return on the underlying assets. You've earned $25,000 in dividends, but your principal is now worth $42,000. Total, $67,000. Your neighbor earned $10,000 in dividends, but his principal grew to $70,000. Total, $80,000. You chased yield and left $13,000 on the table. The fix: target dividend ETFs yielding 3 to 5%, not 8 to 10. Focus on total return, dividends plus capital appreciation. That's where real wealth compounds. Mistake #2. Ignoring the tax efficiency trap. Here's something that absolutely infuriates me. Investors who obsess over a 0.5% expense ratio but completely ignore tax inefficiency. Not all dividend ETFs are taxed equally. Some distribute qualified dividends, which are taxed at favorable long-term capital gains rates, 15 to 20% for most investors. Others distribute ordinary income or short-term gains, taxed at ordinary income rates, up to 37%. That's a massive difference, and it compounds over decades. Imagine you're in the 24% tax bracket earning $3,000 annually in dividends. If those are qualified dividends taxed at 15%, you pay $450 in taxes. If they're taxed as ordinary income at 24%, you pay $720. The difference, $270 per year. Over 30 years, that's over $16,000 in unnecessary taxes. Here's what you do. Check the fund prospectus. Look for the breakdown of qualified versus ordinary dividends. Funds like ST and VYM intentionally structure distributions to maximize qualified dividend treatment. Use them. Also, and this is critical, hold dividend ETFs in tax-advantaged accounts like Roth IRAs and 401(k)s whenever possible. The tax drag disappears entirely. Mistake #3. Overlapping holdings are silently diluting your returns. This one surprises people, but it's real. You own 3 dividend ETFs thinking you're diversified. You're excited about your coverage. But when you dig into the holdings, you realize that 40% of your portfolio is the same 10 stocks across all 3 funds. You're not diversified. You're concentrated in paying 3 sets of fees. I see this constantly. An investor owns VTI, VIM, and ST. Sounds diversified, right? But when you map the overlap, you're heavily concentrated in Microsoft, Apple, Johnson & Johnson, Procter & Gamble, and Coca-Cola. You could have achieved nearly identical results with 1 or 2 funds and saved on fees. Here's the diagnostic. Go to your brokerage, export your holdings, identify your top 20 positions across all your dividend ETFs. If more than 30% of your portfolio is concentrated in those top 20, you've got an overlap problem. The fix is simple. Consolidate. Ask yourself, what's the core exposure I want? U.S. large-cap dividends? International, small-cap value. Choose 1 or 2 ETFs that give you that exposure and eliminate the rest. You'll reduce fees, eliminate overlap, and actually improve your returns. Mistake #4. Timing your entries and exits. I'm going to be blunt. If you're trying to time dividend ETF buys and sells, you've already lost. Dividend investors seem to think they can outsmart the market. They sell before a dividend cut they sense coming. They buy right before they think yields are about to spike. They're essentially trying to time the market with dividend ETFs, and it never works. Here's what happens. You sell VYM because you think dividend yields are about to compress. Then they don't. They actually expand, and you've locked in a loss, or you wait to buy until after the correction. That correction never materializes, and you miss 3 years of returns waiting on the sidelines. The academic research is overwhelmingly clear. Time in the market beats timing the market. Always. The better approach, dollar cost average. Invest the same amount every single month, regardless of price, yield, or market conditions. Remove emotion entirely. Let the market do what it does and just collect dividends and reinvest them. Over 20 or 30 years, this approach creates significantly more wealth than trying to be clever. *** mistake #5. Concentration risk hiding in your diversified fund ** last one, and this is dangerous. Many investors don't realize how concentrated their dividend ETF actually is. You buy a diversified dividend fund, and you assume you're protected. But if the top 10 holdings represent 35 to 40% of the fund's value, which is common, you don't have diversification. You have concentration risk. Sector concentration is another hidden killer. Some dividend ETFs are loaded with utilities and rate. That's fine if that's your explicit strategy, but if you thought you were buying broad diversification, you're actually very exposed to interest rate risk. When rates rise, those sectors get crushed. Check your fund's fact sheet. Look at what percentage is the top 10 holdings. What's the sector breakdown? Is it US only, or does it have international exposure? If the top 10 are more than 40% of assets, find a more diversified alternative. If one sector is more than 30% of the fund, understand that risk explicitly. A better approach: use a combination of broad exposure like VYM for large-cap US dividends, plus targeted positions if you want sector exposure. This gives you control over your actual concentration level. **The fix. Your dividend ETF checklist ** before you buy any dividend ETF, run through this checklist. 1. Is the yield reasonable? Target 3 to 5%, not 8 to 10. 2. Are the distributions primarily qualified dividends? 3. Are there overlapping holdings with your other ETFs? If yes, consolidate. 4. Have you committed to a dollar cost averaging strategy, not timing? 5. Is the concentration in the top 10 holdings under 40%? 6. Is the sector allocation aligned with your actual risk tolerance? Answer yes to all 6, and you're set up for real wealth building. **, the bottom line ** dividend ETFs are genuinely one of the best tools for building wealth over decades. But only if you avoid these 5 mistakes: chasing yield, ignoring taxes, overlapping holdings, timing entries and exits, and hidden concentration. These are wealth destroyers masquerading as investing decisions. You now know what they are and how to fix them. That puts you ahead of 90% of dividend investors who are still making these mistakes unconsciously. Your next step: audit your current dividend ETF holdings again.